Welcome to Secret Off-Market Properties, how to find them, secure them, and profit from them. The next section is the benefits of forming and operating a limited partnership. Please consult expert legal and accounting advice from a street-smart, knowledgeable real estate attorney, securities attorney, and or a CPA. You probably need all those people. But to form a limited partnership is a little more complicated than forming an LLC. Now, before I dive into this, you could just form an LLC and operate that way, and you as the managing partner. But to have a more sophisticated vehicle would be a limited partnership. And I'm going to give you from a practical street smart view of what it's all about. How do you structure and arrange equity, capital, using limited partnerships to acquire real estate? This is a tremendous vehicle which you can use to raise money for your deal. Now, you could be the general partner, and that's what I would recommend, but one step at a time. Let's find out what they all are, what the roles are for the limited partners and for the general partner. The most common vehicle to raise money is a limited partnership, LLCs, and syndications. But this is really the focus of limited partnerships as the vehicle you need to do. A limited partner is set up with the limited liability to the investors. That's what attracts them. They get limited liability. Whatever their risk is solely limited to the amount of money they contribute. The fund or the limited partnership is what you would call it, lives for typically for somewhere around 8 to 10 years. It can go shorter, it can go longer. We're going to use this as a vehicle to buy some property. When you find something that makes sense, you put it under contract. Then you will take that and you will basically assign the contract to the limited partnership. Now, you should get value for doing that because you're the procuring cause, and it's more than just being a transaction facilitator, getting a fee in terms of an acquisition fee. You're trying to get equity in a piece of the deal. That's what a limited partnership is great for doing. There is an investing period when you basically get the money together and you put it out to buy properties, followed by the adding value period where you increase the NOI, the net operating income, that's what it is, and you can possibly raise the value because the NOI times the cap rate gets you a higher value if you've increased it. And then you harvest it, or cash out, by closing out the limited partnership and in getting to each one of the limited partners and the general partner their share as is spelled out in the terms and conditions of the limited partnership agreement. The investment structure is designed to minimize the legal and the financial liability for the limited partners while providing them with significant profits and tax benefits. That's a double whammy, and that's a great way to do it with limited risk. They put the money in and no one can come after them for the difference if there's any issues, which there rarely is, but you want to protect them. And that's one of the things you're going to be able to share with them, that there is limited liability. Their legal and financial risk is mitigated and limited to what they put in. The liability of the general partner, on the other hand, is not limited to his or her investment in a limited partnership. Don't be scared off. That's okay. The general partner has responsibilities and gets income, they get benefits because of the higher risk they're taking. But they're basically taking control of running this limited partnership. The typical fund is organized as an LP or a limited partnership. The general partner in this transaction, I would recommend, since you have unlimited liability, why don't you organize and form a limited liability company and appoint the limited liability company with you as its managing member as the general partner. Now let me repeat that one more time slowly. You as a general partner have unlimited liability. But what if you as a general partner are operating as an entity, as a limited liability company? That means that you have unlimited liability, but you have limited resources they can go for because the LLC has protection. So you can have your cake and eat it too. That is the structure that I recommend, that you operate as the general partner, as a limited liability company. The LLC is the general partner of the limited partnership. That's what you want to do. You want to mitigate your risk. You want to lower your risk. And that's what having the LLC as the operating general partner entity for you protects you and still provides them the protections that the limited partners need. The state where you form your LP, limited partnership, can be important because there are certain considerations you have to have by state. Now, I said in the opening slide, you need to have someone who's a knowledgeable securities attorney or a real estate attorney, and maybe consult also with a CPA. They will be able to tell you what states have rules which are more favorable than others. I'm not going to practice law, and I'm not going to give you which states to recommend. I want you to go based on these people that you're going to talk to tell you, from their legal perspective, where's the best place for you to incorporate, in your home state or adjacent state or someplace else. I'm going to leave that for the legal professionals to do it. The general partner and the limited partners both benefit under the financial structure of a limited partnership. They all receive monies. They put in monies. Some may put more monies in. The general partner may put in some. They may put in limited monies. They may put in the deal as their, basically the quid pro quo for their ownership on one of the shares. It could be they put in cash as well, or they do part cash and part the deal. I don't know how you're going to structure it, but I'm just saying there's flexibility. The general partner receives ownership in the LP for finding the deal as well as for managing the assets of the LP. Now, let's say there's 10 partnership interests, and 8 of them are funded by people who are limited partners who put in the cash. And there's 2 other shares in this pie which are available. If this is one heck of a deal, an awesome deal, now, it may be worth a full share, and there may be other things that you can maybe you buy a share, and you get 2 shares, one you pay for and one you put the asset in. So you have 20% of the overall deal, and you're the general partner. The general partner is expected to and usually will invest some of their own monies in the deal because if you have no skin in the game, that makes them feel a little reticent. But if you get a partnership share, and maybe you get one of those shares, one of those interests for the deal. And then you get 1 share because you bought it. They put in the money for the 8 other shares. Okay, that can make sense. The personal stake in the deal is a significant incentive for the performance because you have skin in this game. You're not just you bring a deal and say, hey, if it does something, I make a boatload of money. That's not the way it works. You put the deal in there to become the resource that brings it to fruition. But you as a general partner are motivated and incentivized to make the yield appear so all of your limited partners receive the amount of money that they're expecting to get. Now, that might be expressed as a percentage, or sometimes it's called a hurdle rate, a minimum that they're to receive cumulatively over the time. And once it goes over that, then there's maybe a bigger pot available for you as a general partner. Now, if you own 2 of the shares and they own 8, that's 10 shares, it's divvied up proportionally. You have an economic interest in it. You got 20% of the deal. So you are motivated to do it, plus you're contractually obligated as a general partner to increase the value of the asset. The asset management fees a partner might get might be in the 1% to 1.5% per annum. So if you've got $100,000 in a partnership, which is relatively low, you'd make $1,000 to $1,500. And obviously, if you go up 10 times more, you make 10 times more. If you have $1 million deal, you're going to be making about $10,000 to $15,000 as a general partner for the asset management. A higher payout is viewed as an incentive for you as the managing partner. It's designed to compensate you for achieving superior investment performance. The better you perform, you're incentivized to get it, because not only do you get your percentage as a partner in the partnership, owning 2 of the 10 shares, hypothetically, you also are incentivized in other ways, and I'll talk about that, where you get money. I've already mentioned one of them is the asset management fee in a $1 million deal. Now, there's some more things we're going to go into in detail on how the general partner gets paid. The general partner usually retains a larger percentage of the back-end profits. After all your limited partners have made their return, and you're at the point where you're at the harvesting stage, perhaps. Now they've got the return that you'd expect them to get. Maybe that was 6, 8, 10, 15%, whatever it is. 15 is a little high. Let's say 8% of their money. So they each got their 8% return on their money cumulatively. So that would be 8% for year 1, 8% for year 2, 8%, and so forth. So once they've received their percentage, then the extra would go to you, and I'll show you how that works. In the back end of the deal, your 20% might be worth 40% of the back end profits. It's not unusual to have a larger percentage on the back end of the deal after all of your partners have made what you told them you're going to make. If that's an 8% return, they got 8% cumulative return for 2, 3, 4, 5, 10 years. Then you can get a bigger piece of the pie at the end. Makes it very long-term, engaged incentive. The limited partnership agreement usually has a hurdle rate, which I mentioned earlier, the return that the investors get. The partners may expect an 8% return on their money, or 6 or 7 or 9. I don't know what it is. Whatever you put in the agreement, whatever you put in the offering, that is what they would normally expect to get, and they're entitled to. So that comes before you get any extra money. Now, as a partner, you're going to 8% on your shares too. Does that make sense? Absolutely. So the hurdle rate applies to you and them. It basically creates the amount of money you have to have made already before some extra money can come to you as a general partner. After the hurdle rate has been reached, the general partner enters into what we call a catch-up period. Not ketchup like ketchup and mustard, but catching up from behind, which catch-up period, which they receive a disproportionate share of the distributions. So let's say you made the 8%, and there's extra money in the partnership. You as a general partner are entitled to get additional return above and beyond that. And that's your disproportionate share of the distributions. The higher split for the general partner would remain in force until they've received their preset portion of the profits. So there's a hurdle number that you have to get, you as the general partner, you're supposed to get on your money. There is what's called a clawback provision to ensure that the general partner is not overcompensated. Now, once you've made your money that you're entitled to, if you go beyond that, then the partners should have a provision in there, the limited partners should have a provision to say, look, you got 40% of the back end of this deal. You've got the extra incentive. But at this point in time, we got 8%, and you're making disproportionate amount of money above what you said you're going to get. Therefore, they're going to reach back in, claw back, and say, on that final distribution, if you made more than your 20% and more than certain other percentages, that they have a right to say, hey, part of that should go to us, to be fair. Now, when you're divvying up that pie again, heck, you own 20% of it. So it isn't really that challenging, it isn't that awkward, and it isn't negative. It's just a provision to balance it out. It lets your partners know that you're not going to be enriched unjustly and disproportionately way above them. Yes, you're entitled to more. You did things that they didn't do. They didn't bear the risk. You did. You brought the deal in, not them. You've done the stuff to make it ready to increase the value, to do the repositioning, to add value, increase the net operating income, and those things necessary to make it worth more at the end. Now, for that, you should get a disproportionate amount of the money, but not to the point where they don't get anything, just they get their minimum hurdle rate. Share with them. Make sure that they get a fair share, and make sure that they understand it. What kind of returns could an investor expect in a limited partnership? The preferred return for the limited partner usually ranges from 8, 9, 10 to 11% per year, plus they get certain tax deductions, which again minimize the taxation on their 8 to 11% return. That makes it attractive. That's why people will put their check out and give you their money and to buy into a limited partnership and give you $100,000 or whatever it is for their shares they're going to buy. After an investment is sold and its capital is set for preferred distribution, then the limited partners are set to receive that percentage on the money, and they get it. Now, if they don't get it every year, then you have to basically make it up cumulatively. First 2 years, maybe you're only making 7, and they're entitled, let's say, to 9. That means in addition to their 9 for the next year, they're also entitled to 2 extra percent. That has to be paid. And that makes sense because now they got what they thought they were investing in. And so did you. The timing and the method of distribution varies from one limited partnership to the next. You may have certain values or certain return on investments or certain holding periods or whatever it is you're going to do. The limited partnership is going to set out what the rules are. So meet with your real estate attorney, your securities attorney, to tell them what you want to do and have them look at what that means to the agreement and spell it out so that you get your distributions and you don't have to beg for it like the orphan in Oliver Twist. It's spelled out in the agreement. And they get the same rights because they know they're going to get their distribution or they're going to cumulative distribution of certain amount. Limited partnerships are a win-win proposition for both the general partner and the limited partners. Some people may look at this and say the general partner has a chance to make more money. Yes, they also took more risk. And yes, we can mitigate or limit that risk, but you're also the person who brought this deal together. You found the property itself, you've managed it over the years, and you've used their money to make incremental value and raise the value of the building. So on the end positioning and the harvesting section, that when you make the extra money, everybody wins. That is the structure and the nature of a limited partnership for both the general partner's perspective and the limited partner's perspective. This is what it's all about. Giving you the solid steps to tap into secret off-market properties so that you can have financial freedom, time freedom, and the life of your dreams. Take care.